Y'all like this? All the decorations I got in the house, guys. I'm not gonna lie. Basically, a plan to save for your kids' retirement. Kids don't retire; they gotta work. Oh, I still get nervous. Oh my goodness, a month in, we're getting better though. Too many souls. I have a problem with that. What's going on, beautiful people? Welcome back to Cha-Ching with Meng. Guys, we fucking made it. I don't even care I cussed. I'm leaving that in there. I am so excited to finally begin the conversation around investing. So without further ado, let's jump right in. Just as with debt, investing is a very complex and dense subject. So for now, it will just be a high-level overview with a lot omitted on purpose. And even still, I'll probably be breaking this up into multiple episodes. So once you conquer your debt, there's a few different places you can put your personal profits. You know, you can go into the stock market, you can save for a home or a side business. If you have a special somebody in your life, you can, save for that very expensive piece of rock. Wink, wink, you know what I'm talking about. Personally for me, I like the stock market because there's a lower barrier of entry. What that means is you only need a couple $1,000s for you to participate, as opposed to something like saving up for a home or saving up to launch a business. You need a lot more money up front to participate in that. Again, guys, I want to reiterate the fact that I am not a pro, nor am I a fiduciary, but I do have your best interests at heart. Quite frankly, you don't need to be a pro to make money in the stock market, and all the data from numerous studies throughout the years show that the quote-unquote pros can't beat the average returns of the S&P 500 on a consistent basis, and that has been very well documented. In my opinion, you just need to understand a few key fundamentals of how the stock market works and invest consistently. Personally for myself, I went from $0 4 years ago. 4 years later, now my portfolio is hovering around. Another public service announcement, guys. I want to reiterate the fact that there is risk here. As with anything, the greater the risk, the greater the reward. But you need to find that fine line between, being an investor and a gambler. That is two distinct groups of people. For key objectives today, I'm going to, one, define my audience. Who is this content built for? Two, I'll break down the alphabet soup of the stock market in terms of common acronyms that you see in the news. Three, we'll talk a little bit about indexes. Four, go into the investment vehicles that you can use personally to invest in the stock market. And lastly, five, as always, ending with a personal finance fitness challenge. So who is this content made for, right, guys? I'm going to try to define my audience, you who's currently watching this video, based off of the data from YouTube Analytics and my Instagram page at Cha-Ching with Meng. I'm going to assume these things. One, you are most likely a millennial, meaning you are anywhere between the age range of 25 to 35. Two, you are spread across the US. We actually have some viewers in the UK and Australia. I find that super cool. What's up, y'all? Thank you so much for tuning in. Two, I'm going to assume you're not filthy rich, right? You don't come from money, you don't have wealth, and you're not a trust fund baby. You are an average day American with some source of income, whether it be 25, 50, 100, 200K a year. You have a source of income, but you want your money to do more for you than just pay the bills, right? You want your slice of that American dream. So if I'm right around any of these assumptions, this content is for you, so please keep watching. Let's take it all the way back to the beginning and just simply define the stock market, right? And for my more technical folks, please don't kill me. I'm going to use everyday terms. So here we go. Stock market is essentially a communal gathering place for buyers and sellers to buy and sell stuff, whether it be shares of companies or commodities such as oil, wheat, coffee, so on and so forth. Now, there are stock exchanges throughout the world, but in the US, there are two stock exchanges here. The New York Stock Exchange, NYSE, and the NASDAQ. The New York Stock Exchange is the cream of the crop in terms of stock exchanges. It's the most valuable worldwide, and it's kind of like the pinnacle, right? The crown jewel. The NASDAQ is the hipper, cooler, younger brother of the New York Stock Exchange. This one came about in the 1990s, I want to say, and it's focused very heavily in the tech space. Moving on to indexes, there are three very common indexes that you will hear in the US, and they are the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. So to give you a definition of an index, think of an index like a college club, right? There are certain requirements for you to become a member, and there are certain requirements for you to stay a member. So breaking down the requirements for each of these clubs, S&P 500. S&P 500 is 500 of the largest companies on the stock market in the US today. The Dow Jones Industrial Average is a bit more of an exclusive club. That only tracks the 30 largest companies in the US. And the NASDAQ is an index that tracks the NASDAQ stock exchange, but it's skewed very heavily towards the 100 largest companies on the NASDAQ stock exchange. These indexes will move based off of how the group moves individually. So for example, if the S&P 500 companies do better than worse, they will track upward and vice versa, right? It's a good snapshot of how large companies are moving on that particular day, week, month, and year. In order for you to invest in the stock market, you need to have investment vehicles. So you can't just go to New York City and slap $500 on the table and say, here's $500, can I buy a few shares of X, Y, and Z, right? It doesn't work that way. That's where investment vehicles come in. They are essentially bank accounts tailored to allow you to invest in the stock market for certain things, whether it be retirement, healthcare costs, or just a standard brokerage account. The most common investment vehicle most Americans have is their retirement accounts. So there are two very popular ones, a 401k and an IRA. So your 401k, like I mentioned before, is a company-sponsored retirement account, and your IRA is an individual retirement account. That is something that you set up yourself on a one-on-one basis. It's really easy, it takes a couple minutes, not too hard to do. Now, for your 401k and your IRA, they come in two different flavors, Roth and traditional. The way you need to think about it is all about when Uncle Sam takes his cut, right? So for example, for your traditional 401k and the IRA, you are putting in money into these accounts before Uncle Sam taxes you. So when you pull that money out, that's when Uncle Sam says, hey, it's pony up, it's time for my share, right? So you are taxed when you pull that money out, not when you put that money in. Keynote here, your profits are also taxed. Now the Roth option is the exact opposite. So if you have a Roth 401k or a Roth IRA, Uncle Sam takes his money up front. So Uncle Sam says, hey, you can put this money in because I already taxed it and got my share. All the money you put in here and all the money and profits that you make are tax-free. So when you pull that money out in a Roth 401k or IRA, Uncle Sam does not touch any of the profits or any of the principal. So for myself personally, I have a mix of Roth and traditional. So my company matches are all traditional based, but my own contributions for my 401k are on a Roth basis. My IRA is also a Roth IRA. Personally, for myself, I'd rather pay Uncle Sam up front and then allow my money to grow tax-free for years and years to come. But again, it's a very personal decision. Find something that works for you and go with that. Moving on to, medical bills, there is something called the HSA, Health Savings Account. This is something that some companies do offer. And again, it is an investment vehicle that you can fund every year, invest in the market, and use those profits to pay for certain medical bills. Last but not least, there's always your standard brokerage account, that you can open with a Fidelity or a Vanguard, where you can just put in additional money to be able to buy and sell shares on the stock market. Those are the most common investment vehicles that Americans are aware of. There are also many others. For example, there are investment vehicles to fund your kids' higher education, right? College costs have been skyrocketing. So there are certain accounts there that allow you to save and invest for your child's education. Personally, I don't have kids, so I don't know too much about it, but just wanted to give you an FYI there. Guys, a clear distinction I want to make is just because you have a 401k or an IRA and you have money in these accounts does not mean you have invested in the market. What do I mean by that? You still need to take that next step and say, hey, I want my money to be invested in X, Y, and Z, right? So make sure you have a 401k or IRA. 2, make sure you fund it. And 3, make sure you choose what you want to invest in. In our next episode, we will discuss all the different types of investments that you can make for the money put in these accounts. For your personal finance fitness challenge, guys, I want you to open the Stocks app on your iPhone, Team Apple for life, and just get comfortable, right? Look at how the markets are moving on a daily basis and read some articles. Granted, you might not know everything and all the jargon, but I want you to just get comfortable with the terminology as we dive deeper and deeper into this subject. I'm going to end this episode with a bit of a brain tickler. So a lot of Americans think the US economy is the stock market and the stock market is the US economy. That is false. And a great example of that is the pandemic, right? The economy is not doing that great, but the stock market has essentially erased all of its losses from its March lows. Now, outside looking in, that might be a little weird, right? But there are 2 big reasons here. 1, the stock market is a forward indicator, meaning buyers and sellers, aka investors, will buy and sell in the stock market based off of what they think will happen in the next 3, 6, and 12 months. And 2, although the stock market is big, powerful, and complex, and the amount of companies represented is quite astronomical, it is not a full picture of the US economy. There are a lot of things in the economy that are not on the stock market. For example, small mom and pop shops and also large private companies. So again, I want to reiterate, the US economy is not the stock market and vice versa. Guys, for your too long didn't read, we finally started on our journey to investing. Anyone who knows me knows that I love this subject, so I'm so glad we're here. Today we only covered the basics, acronyms, indexes, and investment vehicles. Next week's episode, we will talk about the types of investments you can make with your investment vehicles in the stock market. Hope you found this content useful, guys. As always, if you have any questions, drop a comment below or message me at Ching with Meng on Instagram. Like, share, sub, comment, all that good YouTube stuff. And as always, I'm not rich, but I plan to be. Let's go on this journey together. Bye, guys.